Over the last handful of months, we've gone over several different investing strategies, all with their own strengths and weaknesses. We've discussed the impressive consistency and tranquility of the permanent portfolio, the tremendous growth prospects of an all-stock strategy, the balance of the classic 60-40 strategy, and even looked at things from a risk-adjusted perspective with the no-brainer strategy. Today we're going to be looking at what some have called the ultimate buy and hold strategy in the Merriman Ultimate portfolio, or at least as close of an approximation to the Merriman strategy as I can get with the data I have available to me at this point in time. I'll explain the differences in a minute. But according to its creator, Paul Merriman, this strategy primarily seeks to maximize long-term growth, similar to the all-stock strategy, even if it means some additional short-term volatility compared to more conservative strategies like the permanent portfolio. However, unlike the all-stock strategy, the Merriman portfolio includes investments into other assets such as real estate. It also puts a fairly significant amount of its money toward international and emerging market funds, so as to take advantage of any market opportunities that come up, regardless of where they are. But is this really enough to make it the ultimate buy and hold strategy? As a buy and hold investor myself, I'm quite curious to find out. So let's get started. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today. The Merriman Ultimate Portfolio has you split your investments up evenly into 10 different assets. A domestic and international large and small cap blended fund. Merriman specifically recommends a standard S&P 500 index fund for the domestic large cap blended fund, a domestic and international large and small cap value fund, a US-based real estate investment trust or REIT, and an emerging markets fund. The difference that we'll be making in this video is that instead of putting 10% into a large cap value international fund and a 10% into a small cap value international fund, we'll be putting the full 20% into the large cap value international fund. And the reason for this is that I don't currently have much data on international small cap value funds, at least not going back to like the 1970s in front of me. So it is a bit of a modified Merriman portfolio, but it's as close as I can get with the data I have at this point in time. What you'll notice immediately is that this portfolio has 90% of its money going towards some kind of stock, which is almost always going to lead to more short-term volatility. However, locationally speaking, it is pretty well balanced, with a total of 50% of the money going towards investments outside the United States and the rest going towards US stocks or real estate. So while we would expect there to be quite a bit of volatility with this strategy, the combination of large and small companies, real estate, and domestic and international investments will hopefully balance out a small portion of it, so that it is at least no worse than what we saw in the video on the all-stock strategy, which, if you'll remember, was represented exclusively by an S&P 500 index fund. I only mention this because even though we're operating under the assumption that this strategy is primarily trying to maximize long-term returns, I do often see it referred to as the ultimate buy and hold strategy online, and if that is true, then volatility has to be, at the very least, a close second in terms of importance. Because experientially, it's tough for most investors to not take action when they see their investments falling by 30, 40, or 50% in a short span of time. And all the long-term buy and hold returns in the world on paper don't matter much to an investor who is spooked into selling at the wrong time. With that being said, let's start by analyzing the historical long-term returns of this strategy. To analyze the returns, we'll be looking at a few different metrics. We'll be looking at the long-term 40-year inflation-adjusted returns from every year starting from 1976 through the end of 2019. Since again, that's the first and last years for which I have completed data on all of the assets involved in this strategy at the time of this recording. And that is, again, quite a different time frame than we've been using so far for most of the videos in this series. So just like we did at the end of the no-brainer video, at the end of this video I'll also give an update on how the other strategies we've already covered would have performed during this specific time frame, so we can have an apples-to-apples comparison. And as always, we'll also be taking a look at how many times the portfolio lost money and how severe those losses were. Ideally, if this portfolio is doing its job, we should see that it's producing solid returns in line with, or even better than, the all-stock strategy with, ideally, less volatility. Finally, we'll also touch on how dependable or trustworthy the strategy is by examining how sensitive those long-term returns we're seeing are to when you decide to start investing. So based on the data I have, since 1976, the average 40-year inflation-adjusted returns for the Merriman Ultimate portfolio is about 7.7% per year. Its worst-case return was about 7.3% per year, assuming you began investing in 1979. And its best-case scenario was an average return of 8% per year, assuming you began investing in 1978. This suggests that a $10,000 investment would grow to, on average, around $194,400 over the course of 40 years, even after adjusting for inflation. At worst, you're looking at a nest egg of around $167,500, and at best, $217,200. Now, obviously, we have to take these figures with a pretty gigantic grain of salt, since there's only a handful of 40-year time frames since 1976 from which we can get data. To compensate, we'll take a closer look at the rolling 10-year inflation-adjusted returns than we usually do in this series in just a minute, since that way we'll have at least a halfway decent amount of them to use. But for now, let's take a look at some volatility metrics. The average standard deviation of returns for the Merriman strategy was 16.3%. which means that in any given year, we can expect that most of our returns will fall somewhere between the negative 8.6% and positive 24% range within this strategy. Looking at the individual returns for each year in our return diversity chart, we see that roughly 68% of our returns do fall within that expected range. And there was a total of 9 years out of a possible 44 in this case where the portfolio failed to keep pace with inflation, which gives us a loss frequency of around 20%. Thankfully, the majority of those down years were recovered from reasonably quickly, as there again wasn't a single 10-year stretch where the strategy failed to keep pace with inflation. As a matter of fact, it never even got particularly close. Even during its worst 10-year stretch, which unsurprisingly was from 1999 to 2009, it still managed to earn an inflation-adjusted 1.4% per year. Now, I get that this data set only goes back to 1976, which means we're missing out on quite a few major events, most notably the first downturn of the early 1970s and the Great Depression. But it is still somewhat impressive to see that a strategy this heavily invested in stocks managed to outpace inflation in the 2000s, despite going through both the dot-com crash and Great Recession. Its median and average 10-year inflation-adjusted returns were 8% per year, and its best 10-year run was from 1980 to 1990, where it returned 13.4% per year over and above inflation. Additionally, there was only one time that this strategy failed to beat inflation more than 1 year in a row. That was from 2001 to 2003, where it trailed inflation by 6%, 8%, and 15% respectively. In 2004, it rose by an inflation-adjusted 40% to set a new all-time high. Next, let's talk about start date sensitivity. Start date sensitivity, at least as we're measuring it in this series, takes a look at the rolling returns of the 10 years prior to each initial investment date and compares it to the rolling returns of the following 10 years to see how big of a difference there is between the two. It's a good way to get an idea of how dependable or trustworthy an investing strategy's returns have been historically. And ideally, we want to keep our total start date sensitivity, measured here by the difference between the largest underperformance and the largest overperformance, as low as possible. The Merriman Ultimate Portfolio had a total start date sensitivity of 14.3% during this time frame. The largest overperformance was 6.7%, which took place from 2009 to 2019. In those years, the Merriman strategy had an inflation-adjusted return of 8.1% per year, beating out the returns from 1999 to 2009 of 1.4% per year. The largest underperformance was negative 7.6%, when the returns from 1993 to 2003 failed to match those produced from 1983 to 1993. But that just about wraps up our analysis of the strategy's returns. Now let's move on to our crash analysis. A crash analysis is important to do for any investing strategy you're looking at because it's important to know that if you're going to put your life savings into something, that you'll be able to weather the storms when they come, financially and otherwise. In these videos, we look at a few different metrics when analyzing crashes. They are how deep the crash gets at its worst, how quickly the strategy typically recovers from said crashes to reach new highs, and the Ulcer Index, which largely combines the other two metrics into a single number. Unsurprisingly, given the large amount of stocks in this portfolio with very little there to balance them out, the deepest and longest crash during this stretch of years was the Great Recession. It lasted for about 5 years and fell as much as 41% before the portfolio recovered to set a new all-time high by the start of 2014. There were two other downturns of note during this time frame, which were of course the dot-com crash and the downturn of the early 1990s. As mentioned earlier, the dot-com crash lasted for about 3 years, and had a maximum drop of 27% from the previous highs. The crash of the early 1990s also lasted 3 years and fell as much as 21% off of the all-time highs set at the start of 1990. The Ulcer Index during this time period rose to as high as 1.3 during the Great Recession. On average, it hovered around 0.5. And with that being said, let's move on to examining the strategy in regards to financial independence. Historically speaking, the Merriman strategy would have maintained minimum safe withdrawal rates of 5.88% over any 30-year stretch and 7.14% over any 40-year stretch from 1976 through 2019. The worst year to retire using this strategy would have been 1990 for the 30-year stretch, so we'll have to wait and see if the 30-year rates continue to drop lower in the future, and 1979 for the 40-year stretch. I should note that, as usual, due to the varying nature of individual expense ratios and tax situations, neither has been considered in these withdrawal rates. The median rates were 7.29% for both the 30 and 40-year scenarios, and the maximum rates for the same durations were 9.92% set in 1985 and 7.66% set in 1976. The strategy would have maintained a minimum perpetual withdrawal rate of 5.34%. The accumulation phase of financial independence is where you're still putting money away for your future. The primary metrics here are what percentage of our income are we saving, how do our expenses change over time, how long do we plan to be retired, and how long will it take us to reach financial independence based on that information and the performance of our investing strategy. Similar to what we saw last month in the no-brainer strategy, financial independence was not achieved under either a 15 or 30% savings rate. With a 50% savings rate, a hypothetical investor would have eventually reached financial independence in 21 of the 44 possible scenarios. And on average, achieving FI with this strategy and at this level of savings would take about 23 years. The fastest was an 18-year stretch starting in 1982, and the slowest was 27 years, starting in 1987. With a 70% savings rate, the numbers improve even further, with a hypothetical investor reaching financial independence in 34 of the 44 scenarios. On average, achieving FI with this strategy and at this ridiculous level of savings took about 11 years. The fastest was just 8 years, starting in 1982, and the slowest was 14 years, starting in 1999. On your screen now, you'll see the updated return figures for the all-stock, classic 60/40, permanent portfolio, and no-brainer strategy since 1976. What we notice is that the overall returns of the Merriman Ultimate strategy are quite similar to the all-stock strategy. However, it depends significantly less on luck with a start date sensitivity of 14.3%, second best during this stretch among the strategies we've covered so far on this channel, and roughly 20% below that of the all-stock strategy. Its volatility metrics were a bit of a mixed bag. While it did recover from the worst crashes significantly faster than the all-stock strategy did, and failed to keep pace with inflation less frequently, it still fell by almost the same amount during those major crashes, and its standard deviation of returns were also similar. So one thing is for sure, you would definitely feel a difference between this strategy and something like the no-brainer strategy, or the classic 60/40 strategy, and especially the permanent portfolio when it comes to volatility. Of course, all three of those strategies had lower returns than the all-stock or Merriman strategies did, so that's the trade-off. And as far as investing for financial independence goes, the Merriman strategy was easily outclassed by its all-stock counterpart, which is a bit disappointing to me given how much of our allocation went to equities in this strategy. For the accumulation phase, it was much more akin to the classic 60/40 strategy, both in terms of frequency of reaching financial independence and the time it took to get there, though it did hold a small but noticeable lead in terms of time to reach FI at lower savings rates. As far as maintaining your lifestyle once you've reached financial independence, it was also a bit of a mixed bag. It did have the highest minimum 40-year safe withdrawal rate at over 7%, but given how the withdrawal rates were falling as we got closer and closer to the modern day, and how its minimum 30-year safe withdrawal rate placed it behind everything else except the permanent portfolio, I'm not sure how well it'll hold up in the years to come in this comparison. We'll just have to wait and see. So in the end, does the Merriman Ultimate strategy accomplish its goals? Well, if its goals were to generate comparable, if not superior returns to the S&P 500 without significant increases in risk, as we hypothesized at the beginning of this video, then it probably did. Its average and median return figures since 1976 appear to be in the same general ballpark, and the volatility is not too different from the S&P 500. Sure, its standard deviation is a bit higher, but its maximum crash depth is also a bit lower, and its longest crash duration is significantly lower. It's also good to see that it managed to accomplish this with roughly 50% of its investments going towards international sources, so that our hypothetical investor doesn't have to have all their eggs in the basket of one country. That alone may make it a long-term improvement over a straight-up S&P 500 portfolio from a diversification standpoint. However, I'm not sure that I'd be quite willing to say it's the ultimate buy and hold strategy yet. To me, and this is purely my opinion, so feel free to disagree, The ultimate buy and hold strategy should be one that seeks to avoid monumental losses, however temporary they may be, as there aren't many investors that are capable of seeing their nest eggs fall by 40% or more over the course of a couple of years without doing something about it. And if a buy and hold strategy puts an investor in a position where they jump in and try and do something about all the volatility, then it's kind of fundamentally failed as a buy and hold strategy, because the investor is no longer buying and holding. They're trading. But what do you think? Let me know in the comments section below. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.